The Force Index was developed by legendary trader and author Dr. Alexander Elder. It is an oscillator that combines volume and prices to show the balance of power between the bulls and the bears. I will go through its calculations, then use it to program a trend-following strategy for the dollar-yen, which we will backtest over 10 years.
The Force Index is defined as the current volume multiplied by the difference between the current and previous closing price. This closing price difference reflects the imbalance between buying and selling pressures, while volume reflects the level of emotional commitment among traders. When the bulls are in control, prices close higher, and the Force Index is positive. When the bears take over, prices close lower, and the Force Index turns negative. By combining price and volume, the Force Index helps you detect impulsive moves occurring on high volume, which have more inertia and are more sustainable. Conversely, if a large price change is accompanied by small volume, or high volume generates only a small price change, the Force Index flattens, and warns of an upcoming reversal. The raw Force Index, as per the formula above, is extremely jagged. Elder recommends applying an exponential moving average to smoothen the raw values. When using the Force Index to detect pullbacks in a trending market, he recommends using a 2-period EMA of the Force Index. For use as a longer-term trend filter, a 13-period EMA of the Force Index is recommended. MT4 includes the Force Index under the Oscillators section, but it uses a slightly different formula. Suppose you use a 13-period exponential smoothing. This is the 13-period EMA of prices, starting from the current bar, while this is the same 13-period EMA, but starting from the previous bar. The difference between these values is then multiplied by volume. For the most part, the indicator outputs are very similar, and both versions can be used interchangeably. If you've been following my channel, you'll know I'm a fan of using short-term momentum oscillators to enter longer-term trends on a pullback. Elder recommends using a 2-period EMA of the Force Index to detect short-term pullbacks. He offers the following additional guidelines. First, combine the smooth Force Index with a longer-term trend indicator, such as a moving average. When the indicator shows an uptrend, buy when the 2-period Force Index turns negative. Place a buy order above the previous high. If the uptrend resumes, you'll be stopped in. Once you're long, place a protective stop below the latest minor low. Exit the position if the trend changes, as identified by the slope of a 13-period EMA of price. Conditions are symmetrical on the short side. Note that Elder used his guidelines for stocks trading on the daily time frame. Let's now adapt these guidelines for trading on the 1-hour dollar-yen. First is the choice of trend indicator. Elder is a strong proponent of his triple-screen trading system, which means he uses a higher time frame to identify longer-term trend direction, and a lower time frame to fine-tune his entries. Each time frame should vary by a factor of 3 to 5. For the trend indicator, let's use the slope of the 20-period EMA on the 4-hour time frame. If the EMA has been rising for at least 5 consecutive bars, an uptrend is present. So let's go ahead and program that in. For trading on the lower time frames, the 2-period EMA of the Force Index is still too reactive. I recommend a 5-period smoothing instead. I'll wait for a pullback, which will pull the Force Index below 0. I will avoid Monday entries since high trading volumes, and hence sustainable trends, are unlikely. Like Elder recommends, I will place a buy stop at the previous high if the above conditions are met. For exits, I will place a protective stop at the lowest low of the last 10 bars. Alternatively, if the 20-period EMA on the 4-hour time frame turns down, it indicates the end of the trend, and I'll exit the market. Lastly, to avoid weekend gap risk, I will close my trades on Friday. Backtesting on the dollar-yen over 10 years yields decent results. That's a summary of Elder's basic Force Index pullback strategy with minor modifications. Alternatively, you can use the 13-period EMA of the Force Index for trend detection, or use it to detect momentum divergences with price. For a dollar-yen strategy that uses the shaft trend cycle, check out the video at the top right. To learn about another underrated momentum oscillator, the commodity channel index, check out the video at the bottom.